Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. As volatility increases across different currencies, few questions are on the minds of exporters and importers. Can the rising tension between India and Pakistan can make rupee weaker? Should importer consider hedging at the current level? Second, can exporter get 86 kind of a level? Third, where are dollar index and euro headed for next few weeks? In today's presentation, we are going to answer all of the above questions. Let me start with rupee view for coming days first. So the first point is May seasonality impact. If you see the table, it gives us a clear-cut indication that generally in the month of May, rupee closes on a weaker note. Any escalation between India and Pakistan can be a trigger point for rupee weakness. Historically, it is seen that whenever the war news between India and Pakistan comes in, initially rupee reacts negatively, but eventually global factors determine the rupee momentum. So the second important factor which determines rupee momentum is RBI strategy. If we see the table, RBI reserves have increased between Feb end and April end. In the month of Feb closing, it was close to $638 billion. April currently it is at $686 billion. While the reserves have gone up, we need to see whether foreign currency assets have gone up or not. Foreign currency assets have also gone up from 543 billion to 578 billion dollars. This data point clearly indicates that RBI is accumulating reserves at lower level. Now, second reason why we expect or why we are anticipating that RBI will go and accumulate reserve. Let me show you an interesting data point. Last week, RBI bulletin came. So for the month of Feb ended 2025, it was clearly showing that RBI net selling position is close to $88 billion. For the month of January, it was close to $77 billion. So basically, RBI short position has increased from Jan to Feb. Now, if we go back to history, there were two reasons why RBI's position has increased drastically. First, in the month of Feb, if you remember, dollar index was trading close to 109 kind of a level, and at that point of time, rupee was also close to 87.50 kind of levels. So we can assume that in order to stop sharp depreciation, RBI must have increased its sell side position. So to settle this $88 billion short position, we are assuming that near 85 kind of a level, RBI might start cutting down those short positions. Now let us look to what is happening in dollar index chart. If you see the dollar index chart, it is giving us an indication technically that 99 is going to act as a strong support and dollar index can bounce back towards 102.50 levels. Now fundamentally there can be two reasons why dollar index can move towards 102.50 to 103 kind of levels. First reason, market is expecting that there is only 10% probability that Fed will go and cut interest rate in the month of May. Second, any de-escalation between US and China can take dollar index higher. Now, if dollar index is moving towards 102.50 or 103 kind of level, what is the view on euro? We think that there is a 80% probability that euro may 1.15 to 1.16 is going to act as a strong resistance and euro can eventually move towards 1.1150 to 1.1175 kind of levels. Now let us discuss outlook on dollar rupee pair and strategy for exporters and importers. Although there are few positive data points which can take rupee below 85 kind of level. However, in the short term, we are expecting that 85 to 85.20 will act as a very strong support for the pair, and eventually the pair can move towards 85.80 to 86.20 kind of levels. Now let us discuss strategy for exporters. When rupee was trading near 87.50 kind of levels, we were suggesting exporters to increase the hedge ratio between 87.50 to 86 kind of a level. We are always pushing them to increase the hedge ratio. Now at current levels, we will suggest them they can keep a stop loss of 85.10 to 85.20 kind of levels and wait for higher levels of 85.80 to 86.20 to increase their hedge ratio. Now let us discuss strategy for importers. Any dip between 85.15 to 85.30 should use as an opportunity to increase their hedge ratio. They can hedge for the next 30 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.